In a striking shift in global energy flows, China's imports of U.S. crude oil have dropped nearly 50%, reflecting both the country's evolving energy priorities and the broader reshaping of world oil markets. According to recent data from Cutback, China imported just 81.9 million barrels of U.S. crude in 2024, down from 155.6 million the previous year, marking a 46% decline. As a result, China has fallen from being the second-largest importer of American oil to the sixth-largest. This shift has significant implications for global oil markets. Several factors are driving this dramatic drop in U.S. crude imports. First, China's overall crude imports have decreased by approximately 7.2% year-on-year, a decline partly attributed to intermittent COVID-19 lockdowns, high domestic inventories, and scheduled refinery maintenance. However, China has also adjusted its procurement strategy, seeking more competitive or flexible terms. Official customs data suggests a shift away from Western suppliers as part of Beijing's broader approach to securing cost-effective oil while reinforcing its energy security. Recent data from Cutback shows that China has increasingly sourced crude from Russia, Iran, and Venezuela, with the share of seaborne crude from these nations rising from 24% to about 26%. Though this percentage increase may seem modest, it represents a substantial volume of oil given China's vast import base, which can exceed 10 million barrels per day. Russia, offering steep discounts on its Urals crude due to Western sanctions, has become particularly attractive to Chinese refiners seeking lower feedstock costs. Similarly, Iran, under U.S. sanctions, continues to ship crude to China through covert methods, including disabling transponders and conducting ship-to-ship transfers near Malaysia and the Persian Gulf. Venezuela, too, affected by U.S. sanctions, often uses complex payment terms and intermediaries to ship oil, but its discounted prices remain appealing to China's cost-sensitive refiners. This shift toward discounted supplies has not only filled the gap left by reduced Western imports, but also deepened China's relationships with politically isolated oil exporters. The realignment is driven by a combination of economic and geopolitical factors. Economically, Chinese refiners benefit from purchasing crude at prices below global benchmarks, allowing them to either subsidize domestic fuel costs or boost exports of refined products, especially to Asian markets. Geopolitically, diversifying suppliers enhances China's energy security by reducing dependence on any single producer or region, thus minimizing vulnerability to geopolitical disruptions. Moreover, by increasing ties with countries like Russia, Iran, and Venezuela, China bolsters its position in the global arena as a major energy consumer, willing to engage outside the U.S.-led sphere. The flow of sanctioned crude to China is often opaque, with satellite imagery, automatic identification system (AIS) data, and port filings revealing complex shipping techniques. These include turning off transponders and conducting ship-to-ship transfers, particularly in Malaysian waters, to obscure the true origin of cargoes. As a result, official Chinese customs data may not fully reflect the volume of Iranian or Venezuelan oil, as some shipments are mislabeled as originating from Malaysia or Oman. An increase in these imports suggests a clear strategy to exploit pricing differentials. A 2 percentage point change in import origin may sound small, but considering China's massive energy needs, it indicates billions of dollars in redirected trade and a reshuffling of global shipping lanes. Global implications. China's evolving oil import patterns have far-reaching consequences for global energy dynamics. The rising share of discounted crude from sanctioned countries raises questions about the effectiveness of Western sanctions and exposes loopholes that allow oil to continue flowing. By selectively purchasing cheaper oil, China can influence global benchmarks and market sentiment. This trend may also pressure traditional suppliers like Saudi Arabia, Angola, and Brazil, prompting them to adjust official selling prices to maintain market share. For Russia, a key member of the OPEC+ alliance, discounted sales to China could undermine efforts by other OPEC members to maintain higher price levels. On the geopolitical front, growing ties between China and sanctioned oil exporters may alter international alliances, positioning China as a key global player engaging with countries outside the Western economic order. In summary, this shift not only helps China secure more affordable energy, but also strengthens its global influence, reinforcing its position as a leading energy consumer navigating a rapidly changing world oil market. Strengthening Beijing's global leverage. As Beijing continues to advance its economic and geopolitical strategies, it is strengthening its influence not only within its own region, but on the global stage. This shift is expected to have far-reaching consequences in international trade, diplomacy, and energy markets. By leveraging its growing economic power, China is positioning itself to set the stage for significant changes, particularly in energy consumption and global relations. As China's role in these markets grows, its influence on energy policies, trade agreements, and diplomatic initiatives is likely to intensify, altering the global landscape in fundamental ways. The rise of electric vehicles and renewables. One of the most significant developments in China's economic strategy is its rapid adoption of electric vehicles, EVs, and renewable energy. In recent years, China has made incredible strides in EV production, with the country now leading the global market in terms of both manufacturing and adoption. This shift directly impacts global oil demand as more and more Chinese consumers turn to EVs. The country's government has been actively pushing for electrification in both transportation and industry, creating a substantial market for clean energy technologies. This transition to electric vehicles will likely lead to a long-term decrease in China's oil import needs, diminishing the country's reliance on crude oil as the backbone of its energy consumption. As the demand for oil decreases, China is shifting its focus toward alternatives, including cleaner energy sources such as liquefied natural gas, LNG. The growing availability of LNG, along with the country's heavy investments in renewables like solar and wind power, further reduces China's dependence on traditional crude-based energy. This energy shift gives China significant geopolitical and pricing advantages, positioning it as a key player in the transition to cleaner energy sources. These developments could have lasting implications for both global energy markets and international relations are influenced by China's evolving approach to energy diversification. A critical element of China's growing global influence is its strategic economic alignment with Russia and Iran. Over the past decade, particularly after the 2014 annexation of Crimea and subsequent Western sanctions, Russia has pivoted significantly toward China, especially in the energy sector. With Western sanctions hampering Russia's access to international markets, China has become an increasingly important trading partner. This collaboration intensified following Russia's 2022 invasion of Ukraine, which led to even stricter Western sanctions. In response, Russia began offering discounted energy exports, particularly crude oil, to China, creating an advantageous situation for Beijing. By 2023, bilateral trade between China and Russia reached a record high of $240 billion, with energy exports comprising a large portion. A significant milestone in this growing partnership is the 2024 completion of the Power of Siberia gas pipeline, which significantly improved China's access to Russian natural gas, further cementing economic and strategic ties. Similarly, China's relationship with Iran has been shaped by ongoing U.S. economic sanctions. Despite these sanctions, which aim to curb Iran's oil exports and limit its financial resources, China continues importing Iranian oil, often at discounted rates. This arrangement benefits both countries. China secures affordable energy, while Iran maintains a crucial economic lifeline amid its isolation from the global financial system. In October 2024, the U.S. imposed new sanctions targeting Iran's petrochemical and oil industries, aiming to diminish Iran's ability to fund its missile programs and other activities considered destabilizing. These sanctions are part of a broader strategy to pressure Iran. However, despite these efforts, China continues supporting Iran's energy sector, ensuring a steady flow of revenue from oil exports. This complicates U.S. efforts to isolate Iran, highlighting the geopolitical complexity arising from China's strategic partnerships. China's strengthening energy ties with Russia and Iran have implications for its trade relationship with the United States. By securing discounted oil and natural gas from these sanctioned nations, China gains a competitive advantage in the global energy market. This shift could reduce China's reliance on U.S. energy imports, especially amid ongoing geopolitical tensions. By diversifying its energy sources and relying less on traditional Western suppliers, China is positioning itself to better withstand potential economic or diplomatic conflicts with the U.S. Geopolitical considerations are central to this shift. as China seeks to diversify its energy sources and reduce its exposure to Western political pressures. China strengthens its energy security and global influence by partnering with countries like Russia and Iran, often at odds with the U.S. This approach not only secures energy resources but also reshapes the geopolitical order in China's favor. These partnerships extend beyond energy, serving a broader strategy to counter Western influence and increase China's autonomy on the global stage. By deepening these ties, China positions itself as a counterweight to the U.S. and its allies, undermining Western dominance in global politics. This strategy aligns with China's Belt and Road Initiative, BRI, a global development strategy aimed at expanding China's influence through infrastructure and trade. The BRI is central to China's geopolitical vision, and partnerships with Russia and Iran are key to its success. These energy relationships not only secure resources, but also increase China's influence in regions traditionally aligned with the West. As China solidifies these relationships, it creates a multipolar world order where its influence is more pronounced, and its ability to dictate trade terms is stronger. China's growing dominance in the electric vehicle market and expansion of renewable energy further enhance its global energy position. These changes shape China's future and alter global trade, diplomacy, and geopolitical power dynamics. By deepening economic ties with strategic partners, China remains central to the global energy transition and the international political landscape. The decline in U.S. oil exports to China could lead to an oversupply in the U.S. market, putting downward pressure on domestic oil prices, potentially harming U.S. producers, reducing revenues, and leading to decreased investment and job losses. A sustained drop in exports could widen the U.S. trade deficit, impacting broader economic indicators. This shift is driven by geopolitical tensions and evolving trade policies. The U.S.-China trade war, marked by tariffs and trade barriers, has pushed China to diversify its energy imports, lessening its reliance on U.S. oil. This highlights the complex relationship between economic policies and international relations. China's journey from a net oil exporter in the early 1980s to the world's largest crude oil importer reflects its rapid economic transformation and growing global influence. This transition underscores the interconnectedness of industrialization, energy security, and geopolitics. The shift began in the early 1990s, fueled by rapid economic reforms and increasing energy demands. Industrialization under Deng Xiaoping significantly increased domestic energy consumption. China's domestic oil production couldn't keep up with the growing demand, so it turned to nearby regions like Southeast Asia for imports. By the early 2000s, China's energy demand surged, spurred by its entry into the World Trade Organization, WTO, in 2001, and its subsequent economic boom driven by manufacturing and infrastructure development. Oil imports steadily increased, reaching over 4 million barrels per day by the end of the decade. This period also saw the development of key infrastructure, such as pipelines and refineries, to manage even higher import volumes. The 2010s marked an era of unprecedented growth in China's oil imports. By 2017, China had overtaken the United States as the world's largest crude oil importer, a milestone reflecting both industrial demand and a growing consumer base. During this time, China began diversifying its oil imports, reducing its dependence on Middle Eastern oil by increasing imports from Russia and Africa. By the end of the decade, China's imports had reached about 10 million barrels per day, cementing its central role in global energy markets. Despite the global disruptions caused by the COVID-19 pandemic, China's oil imports remained strong, averaging about 11 million barrels per day. Strategic stockpiling played a key role during this period, as China took advantage of plummeting oil prices to fill its reserves and ensure long-term energy security. In the following years, imports fluctuated due to shifts in domestic demand and the ongoing effects of the pandemic. Yet, imports reached a record 11.3 million barrels per day in 2023, fueled by a robust post-pandemic recovery. China's decision to reduce or eliminate oil imports from the United States while deepening energy ties with BRICS nations, particularly Russia and Iran, marks a significant shift in its energy and geopolitical strategy. This move highlights China's pursuit of energy security through diversification, cost reduction, and stronger alignment with strategic allies within the BRICS framework. However, this realignment has significant implications for the United States, both economically and geopolitically. China's pivot away from U.S. oil imports aligns with BRICS's broader goals of establishing a more multipolar economic and political world order. The West's sanctions on Russia following the Ukraine conflict have given China the opportunity to access discounted Russian crude, further incentivizing this shift. Meanwhile, China's increasing energy imports from Iran provide further diversification across different continents, reducing its exposure to disruptions tied to U.S. trade policies or geopolitical tensions, and reinforcing its energy independence. From an economic perspective, discounted oil from Russia and other BRICS countries allows China to meet its energy needs at a lower cost. Additionally, these relationships allow China to bypass the U.S.-dominated global oil trade system, potentially using alternative currencies like the Chinese yuan for transactions. This undermines the U.S. dollar's dominance, which has long been a cornerstone of U.S. economic power. The decline in U.S. oil exports to China could disrupt the U.S. energy sector. China has historically been a major market for U.S. crude oil, and its reduced demand could lead to oversupply in domestic markets, potentially driving down oil prices. This would squeeze profit margins for U.S. producers.